Welcome and joining me, Gregor Turon, Chief Investment Officer at GraySwan, for our April macro outlook. Let's start off at looking at COVID-19 infection rates. We can see that the countries that are leading the vaccine rollout, such as United Kingdom and Israel, have been able to maintain very low infection rates. We've seen spikes in India, spikes in Canada, and also slight spikes in the United States as well. From a death rate, we are seeing that Israel and the United Kingdom are again doing well. The United States have had some increases over the last week, and certain countries are really struggling, such as Brazil. Brazil has not implemented very hard lockdowns at this point, and that they're currently paying the price. South Africa is still doing well at this point. From a stringency index perspective, and all that it is really looks at the level of lockdowns globally, you can see that the United Kingdom and Israel has been able to slow down those lockdowns or release some of the lockdowns. South Africa has been very active in terms of the levels of lockdown, and we believe the government has done well as we've been able to have some of the lowest level of lockdowns in place relative to some of the big developed markets. From a market perspective, if you had to ask yourself today, a year later, after the peak of the COVID-19 pandemic, how far would markets be up? And I don't think the answer would be that the S&P is up 68.77%. So if we look at the markets today, from the bottom of the financial crisis or equity markets, the S&P 500 is up 68.7% in base currency, meaning in dollars. Also, I don't think a lot of investors would believe that the JSE is up 68%, just as far up as the S&P. The JSE has outperformed other emerging markets, Europe as well. We've also seen property markets recovering from that point in time, but haven't recovered as hard as what the equity markets have done. I think a key point to this slide is that investors need to stick to their long-term investment strategy. For those investors who had sold out of equity markets at the bottom of the equity markets at the peak of the pandemic, they would have missed out on the biggest or quickest equity market rally we have seen in 100 years. From a year-to-date perspective, we can see that the JSE has again performed very well. The JSE is up 14.44%, outperforming the S&P and various other markets. We've spoken about this reflationary trade, investing into assets that should do well as bond yields increases or as inflation starts coming through. You can see that US property, global, South African property is also value stocks that outperform growth stocks. And the reflationary trade has worked for this year so far. From a Rand perspective, we can see that the Rand runs through various cycles, and currently with the Rand trading at 14.50, we do think that the Rand's trading at fair value, and it's possibly a good time to start taking money abroad again. This graph just looks at the 12-month rolling performance of the Rand against the US dollar. And what you can see during peaks in equity markets or crisis periods, you'll see that the Rand depreciates. And you can see during the tech bubble of 2000, the Rand depreciated by close to 60%. During 2008, the Rand depreciated by 50%. And during the 2020 COVID-19 pandemic, the Rand depreciated by close to 30%. The key here is when normality returns, the Rand typically strengthens. And it's at these points in time, at the peak of Rand depreciation, need to look at either putting in currency hedges, which we do for clients where we're able to, or taking some profits on the currency and bringing money back to South Africa. At this point in time, we can see at the bottom here, the Rand's strong based on the 12-month rolling figures, and therefore we do think it's a good time to start taking money abroad again. We need to look at the S&P 500, because if you take money abroad, asking yourself what valuation is the S&P at this point in time. This graph shows you the historical crisis periods of the S&P, and if you look at the 2008, 2019, 29 periods, you can see it takes a very long time for equity markets to recover from the big losses or the drawdowns. What have we seen during the COVID-19 pandemic? We saw that one of the biggest or quickest sell-offs in the S&P and also the quickest recovery. This has been driven by the biggest stimulus we've seen in history. And therefore, markets are quite expensive at this point in time. But we need to look at equity markets or the S&P during the last five periods of drawdowns. This is on a month-on-month basis. And you can see here November 2007, and during the tech bubble crash, it took markets 81 months and 65 months to recover from those drawdowns. We've just seen the markets recovering within just 4 months. That number is on a month basis, on a daily basis, markets were down close to 35%. At the point in time where equity markets recovered from that drawdown, what was the valuation or the PE valuation of the markets at that point in time? And you can see that the current PE valuation, or the CAPE ratio, which we look at, is higher than the CAPE ratio at any period historically. And at the bottom, you can see the historical CAPE ratio, or the PE ratio, from 1880. And here you can see that the CAPE ratio currently, or the price to earnings ratio, is at 36.6%. Basically means that only during the 2000 tech bubble has the US market been this expensive. Not only do we look at equity market valuations, we look at sentiment. You know, the way we feel as consumers, that drives our behavior, and the more positive or optimistic people feel, the more they would invest and the more they would drive up equity markets. And it's at the inflection points we need to be careful. What we can currently see is that the sentiment is at some of the highest levels we've seen over the last 20 years. Also, we look at the amount of days these sentiment levels have been at extreme values, and it's been at extreme values more than 100 days. Therefore, again, we think equity markets are quite risky at this point in time. What else do we think the equity markets is not pricing in? Well, if you look at December 2017, when the previous president, Donald Trump, came in and cut US corporate tax rates from 35% down to 20%. So what did that mean? It effectively means companies made more profits because they had to pay less tax. Therefore, earnings went up of companies. Therefore, the valuation of companies went up. And we saw a rally in the S&P and the US stock market again due to corporate tax rates. What is President Biden aiming to do? Well, he aims to increase corporate tax rates from 20 or 21% up to 28%. And if you think what happened in 2017, you should expect the opposite to happen in today's market, where tax rates increases. But we haven't seen this in the US stock market. So we don't think Wall Street is actually pricing in corporate tax hikes at this point in time. What about inflation? Well, inflation expectations we do look at. And we look at the 10-year minus the 2-year Treasury yield. And all that it does is it really shows you that as the graph goes up, it means there's a higher expectation for inflation. Why do we look at this? Because we think during certain environments in the market, inflationary or deflationary environments, certain asset classes should do well. And we think that clients should position their portfolios or diversify their portfolios into assets which give them some protection if we see further increases in inflation. So do we see inflation? Well, yes, this is on Twitter on the left-hand side. You can see the amount of timber or lumber you could have bought in 2018 for $800 and how much you could buy today, substantially less. For those of you that do go shop at Woolies, and the avocados, 2 avos were almost 64 Rand, which is just shows you the cost of inflation going up. And the question is it just avos? Was there a shortage of avos? Yes. But the question is, was there a food inflation, or is there food inflation coming into the market? So let's start off looking at the February South African inflation number. That number was 2.9%. Is this inflation we are feeling as consumers? The answer is no. Because if you look at food prices just over the last year, we can see that bananas are up 66.4%. White bread up 32%, cake flour up 31%. We've seen massive increases in food prices across the board, and that's driving inflation. Luckily, I don't have 2 teenage boys, because I think they would bankrupt me if they had to eat all this food at these inflationary prices. So what's also caused inflation? Well, globally, the cost of shipping has skyrocketed by 300%. And why is this? It's because of pent-up demand. Last year, at the peak of the pandemic, suddenly there was no demand for consumers because of fear. And as we got used to the COVID-19 pandemic and sort of started to normalize a bit more, suddenly consumers are spending again. And there's a big demand. That the demand is so big currently that it's increased the cost of shipping containers. This is also causing inflation. We've spoken about inflation and why it's important, and this graph just shows you, if you look at the 10-year real yield, so the bond yields versus inflation in the US, and the value index, meaning value stocks versus growth stocks, you can see the correlation. And therefore, we do think that in this environment where there is this possibility of yields going up further, inflation going up further, then value stocks could do actually well. So you need to tilt into different sectors of the equity markets. Talking about inflation, oil drives a lot of inflation. Oil is one of our biggest, South Africa's biggest importers. We can see the cost of petrol again going up for us as consumers, again, inflationary, money out of our pockets. And this graph just shows you the year-on-year oil price movements. And we've just witnessed, out of the last 30 years, one of the biggest increases in oil prices. The concern for us is that historically, when this has happened, we've typically seen some issue in the equity markets or in the financial markets. In 1987, we had the 1987 crash. 1991, again, big oil spikes caused the recession. We saw the Asian crisis in 1997, the dot-com bubble in 2000. Look at the movement in oil prices there. And again, the credit bubble, big move in oil prices there. So historically, there has been issues when oil prices spikes out. So again, I think we just have to be a bit vigilant at this point in time. Speaking about oil and looking forward, at GraySwan, we do make asset allocations for clients. We make recommendations to move positions within portfolios. And that's what we do on an ongoing basis. But we also have long-term structural views in terms of where we think the world's going to move to. And we think investors need to really sit down and think, where should we invest today for a world in 30 years' time? And this comes back to energy. Oil, that previous slide I showed you. If you look at oil production, which is mainly the burning of fossil fuels, account for around 3/4 of global greenhouse gas emissions. Not only is energy production the largest driver of climate change, the burning of fossil fuels and biomass also comes at a very large cost to human health. The world therefore needs to shift away from fossil fuels into other sources of energy. So this shift, which we think will take place, will not only be driven by the way us as consumers react, but it will be driven by regulation. And if you look at regulation that Biden wants to implement in terms of climate change, is that the US wants to achieve 100% clean energy economy and net zero emissions by no later than 2050. So this 30-year plan we're speaking about. It's not only the US, EU also aims to be climate neutral by 2050. So regulation will drive a structural shift or change in the world for the next 30 years. And you need to look at investment opportunities. And then if we look at the primary energy consumption by source, in time historically, you can see a big energy source has been coal and oil. And these are the commodities which the world needs to move away from. And I believe that if we look at this graph, 30 years from now, it will be very different. You'll see a big allocation into solar, wind, hydropower, and so forth. And therefore, we think there's a big investment opportunity to look forward over the next 30 years and invest in certain sectors of the market. So if you look at renewable energy and the storage of technologies, there's certain commodities which will be required. And therefore, we think there is this opportunity to potentially invest in certain commodities where demand will be driven into this new world we're going into. Aluminium, for instance, you can see it is used in batteries and solar and in wind power. Lithium will be used in batteries for the storage of electricity. So therefore, we think there will be this drive towards demand for these commodities. Not only demand for commodities, certain companies in the market, which will focus on these sectors, we think will do well over the next 30 years. And therefore, you need to look forward over the next 30 years. And maybe the S&P will look completely different to what it looks like today. Not only do we look at the companies and commodities, we look at sort of the potential demand side or the demand increases. And you can see here cobalt, for instance, lithium, nickel. Some of these commodities will see dramatic increases in demand. And we think there's an opportunity here because as demand increases, it should push up prices over time. So in summary, I believe we have been disrupted. I believe the world will change from here on. We do need to look at new investment themes within the equity markets or within the bond markets. And one of these themes we do look at is this world of a lower carbon emission world. And we think there are big opportunities here for the next 30 years. Thank you for joining me, Gregor Turon. Keep well.